Using the wrong legal structure to buy a business can cost you hundreds of thousands of dollars in taxes and even lock you out of the market of buying a new home. So most small business deals are done in what's called an asset sale. So what this is that you are buying, like it sounds, the assets of the business. But the assets aren't just the tools and trucks and things that you can touch. You're also buying the intangible assets. So you're buying the name, the brand, the customer list, the employees, really everything that goes along with the business. So from a customer and employee perspective, the business is just going to continue on as it always has. But from a legal perspective, there's going to be a new legal entity created, and that new legal entity is going to acquire all those assets of the old entity, and we have a new business starting fresh day one. Now, this is nice because it naturally leaves a lot of liability with the seller. Everything starts fresh. There are some types of taxes, payroll taxes, and I believe state sales tax that could possibly transfer to the new entity, even though you did an asset sale. If you do the other type of sale, the stock sale, there are some ways to limit your liability as well. But the asset sale is the easiest way to do that. But the biggest benefit of the asset sale is that you get to depreciate the assets when you buy them. So, and that's only the tangible assets. You don't get to depreciate the things you can't touch, like the brand or anything that you're paying above the value of the physical equipment. Today, as I'm recording this, you get to depreciate 60% of that value in year one, which results in a huge tax break for you when you need it the most, really in that first 1 to 2 years, that you can essentially not have to pay taxes for those first 2 years. There's a bill floating around Congress that could bring that back up to 100%. Used to be 100%, it's fading away. If this bill passes, you'll get to depreciate 100% of those assets when you buy the business, which is a huge tax advantage. Now, one problem with the asset sale is for businesses with lots of vehicles that are going to be on the road, you have to transfer the title in the name of every single one, and that can cause some issues where you might have trucks not on the road because they're not legally registered anymore, or you're just going to have to drive them illegally, which you really shouldn't be doing. So in that instance, you'd want to do a stock sale. So in a stock sale, all those vehicles are going to stay in the name of the company, and you don't have to do the same level of retitling. Then, of course, when you retitle the vehicles to an asset sale, you have to pay the sales tax as well. So you can save some money in sales tax when you do that. Now, a stock sale is when you're buying the legal entity of the prior company. So that means that the business is going to continue on. There's no point where that one ends and the new one begins. It's just a continuation of the business. Now, like I said, that works really well for companies that have lots of vehicles. It also comes into play if you plan to relocate for the business. So if you're planning to move, you really need to do a stock sale, because in an asset sale, the new company starts fresh. It has no history. So when you go to get a mortgage, the lender is going to say that business has no history. We can't lend you money to buy a house. You can't qualify for a mortgage. But if you do a stock sale, because that history continues, you can do that. And we just did this with a client. He just closed on a house yesterday as we're recording this. The lender, when it was structured as an asset sale, told him he couldn't do it. He let us know. So we said, hey, we'll just structure it as a stock sale. We'll get it through. He just bought a new house yesterday. Now, the big negative of a stock sale is that you don't get to depreciate those assets. You don't get the benefit of that depreciation. But there is a way to get around that. So there's what's called a 338H10 election, where the deal is treated as an asset sale for tax purposes. So for legal purposes, it's a stock sale, but for tax purposes, it's an asset sale. So you get the best of both worlds. You're going to get to depreciate the assets. You're going to get the tax benefit. But that's something you need to negotiate right up front with the seller, because essentially it means that the seller's taxes are going to be higher. So when you do a deal, the seller pays higher taxes in an asset sale, and they pay higher taxes in a stock sale with the 338 election than they would in a straight stock sale. Because in a stock sale, they only have to pay capital gains. In an asset sale, they're going to have to pay a much higher tax rate. So structuring this right can save you a lot of money, whether it's on titling, whether it's on taxes, and whether it's allowing you to buy a home for your family. If you need help, reach out and we can buy a business together.